When receiving partnership interests in exchange for services rendered, there are two types of interests to consider: capital interests and profits interests. Several factors will determine which type of interest will be most appropriate. Each has its own pros and cons, and each has their own tax considerations. In this video, I'll discuss what profits interests are and how both vested and unvested profits interests are taxed. A profits interest gives the person a right to a percentage of future profits and no right to any current capital. Essentially, it's an interest in the future profits and appreciation of the partnership. An owner of a profits interest doesn't have an immediate capital account at the time the interest is granted. Capital would only accumulate if there are future profits to share in. A vested profits interest is fully vested and unrestricted if the interest is transferable, free of substantial risk of forfeiture, or if it isn't subject to a substantial risk of forfeiture. If a person receives a profits interest for providing services to or for the benefit of a partnership in their capacity as a partner or in anticipation of becoming a partner, then the grant of the interest is not a taxable event, and the person won't recognize income upon the grant of the interest. That said, there are three exceptions to the general rule of non-taxability. Number one, the profits interest relates to a substantially certain and predictable stream of income from partnership assets, such as income from high-quality debt securities or high-quality net lease. Number two, within 2 years of receipt, the partner disposes of the profits interest. Or number three, the profits interest is a limited partnership interest in a publicly traded partnership as it's defined in the Internal Revenue Code. Initially, the tax treatment of an employee or service provider who received a substantially unvested profits interest was unclear. In 2001, the IRS issued rulings to offer more clarity on the issue, which essentially states that even if a partnership grants a substantially unvested profits interest in the partnership, the person will be treated as receiving the interest on the date of its grant, provided that all the following requirements are met. Number one, both the partnership and the person being granted the interest treat the person as a partner from the date the profits interest is granted. Number two, the person being granted the interest takes into account the distributive share of partnership income, gain, loss, deduction, and credit associated with that interest in computing their income tax liability for the entire period during which the service provider has the interest. And number three, no compensation deduction is taken by the partnership or any partner in connection with the grant of the profits interest. It's important to note that the ruling requires the gains and losses of the partnership be allocated to the person being granted the interest from the date of the grant. It also requires consistent tax treatment by all parties. If you have questions about taxation of either vested and unvested profits interest, contact your untracked early representative to learn more, and be sure to watch our videos on capital interest to see how they differ from profits interest in nature and in taxation matters. I am Shazeb Jabbar with Untracked Early.